Hi, welcome to handout 14. In this handout, we're going to be looking at what's called the cost of capital for entities, and that's going to be a set of discount rates, one for debt projects and one for equity projects, that we're going to start using going forward when we apply things like the NPV method to evaluate a company or a company's debt. And sometimes when we're looking at debt, we'll use the IRR method instead of the NPV method. The other thing we're going to be doing in this handout is looking more closely into the tax shield effect. And the tax shield effect is it mitigates the problem, the added expense of interest when you take out debt on your bottom line, on your net income. And we'll see how that works with a couple of examples. All right, so with that, let's not waste any more time. Let's just jump right in. Okay, so here we are in handout 14, which is going to be all about costs of capital and tax shield for entities. So as usual, let's jump right in. I want to start out with a few reminders. Remember, we're using mostly NPV method now to evaluate projects because it's the most robust method. It always works, things like that. The IRR method is, however, very good for things like bonds and loans and mortgages, mortgage loans, etc. Okay, so with our NPV method, the cash flows we've been using have been the risk-adjusted project cash flows, and we've been discounting with our opportunity cost of capital, or just cost of capital for short, which we've pretty much developed through the opportunity investment model. And our definition for opportunity cost of capital from that model is our known interest rate for a diversified set of alternative projects with similar market or industry risks. And another reminder, final reminder for today, is that we've needed a whole bunch of assumptions. Okay, to make everything work, I don't need you to know what all these assumptions are. All I do need you to know is that to make any of these models work that have anything to do with the future, we need a whole bunch of assumptions. Okay, so with those reminders in our back pocket, let's move on to costs of capital for entities. And in general, entities have two costs of capital. One is going to be for debt, right? If they borrow, if they issue bonds, things like that. And the other is going to be for their stock, if they issue new stock, et cetera, et cetera. So key thing here is that both of these costs of capital are interest or discount rates. Okay, so even though we say cost of capital, we're always talking about an interest rate or for debt or an interest rate or discount rate for equity. So let's look, for example, at what we mean by this in the case of debt for an entity. Let's say we have a company who wants to borrow $1 million to develop and market a new product. Okay, so clearly they want $1 million in debt capital for this project, and they go to JP Morgan Chase and they get a $1 million 5-year 5% interest loan. And to keep things simple, let's say there are no fees associated with this loan. So in that case, we would say the cost of capital for this project, for them, for developing this new product, is 5%. And maybe even a better way to think of it is that the company needs to pay an interest rate R of 5% to get this capital, and that's going to be their RD for this project. So let's think of how this could work in the case of equity capital. So I'm going to do a simple, unusual example, but it is nonetheless a realistic example for what are called special purpose entities. So here's how it works. Let's say we have a startup company that wants to issue $1 million or 1,000K worth of stock, and that's going to be all the stock for the entity. And it wants to get that money so it can establish a black box that it believes that it hopefully will provide the owners, the shareholders, with an estimated 100,000 in dividends for 2 years. And then at the end of 2 years, the company will be liquidated. So that means its assets will be sold and its liabilities will be paid off. And the startup company management believes their best estimate is at that time, after they've paid off all the liabilities, they'll be able to return to the owners another estimated $1 million. So this is typical type of thing for what's called a special purpose entity. It's planned to have a finite life, and et cetera, et cetera. So in this case, the cost of equity capital is coming from the shareholders requiring that equity investment to grow at an estimated rate of RE. So they're doing that in return for participating in the project. They're demanding that the money they put in grow at RE%. So it works like this. So they put in the 1000K now, okay, and that's going to translate to a tranche A growing at RE% to an estimated 100 in a year, and a tranche B growing at RE% to an estimated 1,100K in 2 years. So we can, with this knowledge of what the projected cash flows are, we can solve for the interest rate that equity investors are going to demand to participate in this project. So let's go ahead and do it. So my 1,000 here is our PV total, okay, and that's equal to 100 divided by 1 plus RE raised to the, let's keep all our time units in years, raised to the 1 plus, then at the end of 2 years, they get 1,100, and we've got to discount that back by 1 plus RE raised to the 2, okay? And we can plug this in, or something like it, into Excel. Let's see. And I'll just plug that in here. Okay, and now you could solve for this using the quadratic equation, trial and error, financial calculator. So I'm going to use trial and error, and I'm going to put in 10%, and let's see what I get here. Okay, so if you plug this in RE, if we use trial and error on this, and we try 10%, you'll find that this works. Okay, so let's plug this into Excel and see if we can find out what RE is equal to. Okay, so we could solve this using the quadratic equation, we could solve this using trial and error, we could solve this using a financial calculator. I'm going to try trial and error here. So I'll take as a guess for RE 10%, and I'll put that in here. I'll put that in here, and it didn't like my comma up here, and it's changing that, so that's fine. And I do get 1,000, so you can see 1,000 is equal to 1,000 if I use the correct RE of 10%. So what does this mean? This 10% is the growth rate, the interest rate, okay, that the startup has to promise potential investors in order to attract them to participate. Okay, so no, okay, no contract, okay. Nothing is guaranteed in this case. Okay, that's unlike the situation for debt where there is a contract and JP Morgan is going to get its 5% unless the company defaults on the contract. Completely different situation here with the special purpose entity. This is what the equity investors are hoping they're going to get. This is what the management of the startup hopes to provide them, but absolutely nothing is guaranteed. And if the equity investors don't get this, they can't take over the company, they can't sue the management, that type of thing. Okay, so now going forward, our DCF valuation models, when we're looking at them, and again, NPV is going to be our main one, we're going to adjust things a little bit. So our ROCC will still be the cost of capital for the project, and depending on whether it's a debt project or an equity project, our cost of capital will be RD for debt projects, and our cost of capital will be RE for equity projects. And we're going to start using new techniques to find our opportunity cost of capital for debt and equity projects instead of using what we've used before, the opportunity investment model. And also, as was the case in previous chapters, our opportunity cost of capital will also sometimes be called RM. RM stands for our market. Okay, so we just want to remember that. So now let's take a deep dive into the cost of debt capital for entities. The first thing we want to know about this is that there are two main measures of the cost of debt capital for entities. We can measure the cost of debt capital for entities on a pre-tax basis, and that's easy to understand because it doesn't include any effect seen on the income statement. So if we're ever measuring cost of debt capital and the income statement is not involved, then that's going to be a pre-tax measure, okay? And what we're going to see when we get to the income statement is there is what's called a tax shield effect of using debt capital, which is going to reduce what the entity pays in taxes. But we'll get to that in a bit. The second way to measure cost of debt capital is post-tax, and you're always going to know if you're dealing with a post-tax cost of debt capital because it's going to involve one way or another some information from the income statement, and that of course is going to include the tax shield effect. So in general, our RD pre-tax is always going to be greater than or equal to our RD post-tax. And that's going to be because of this tax shield effect. Okay, so let's look at several pre-tax measures of our cost of debt capital. Okay, in general, if we're looking at a single project, like we did with the JP Morgan Chase example up above, the cost of debt capital is the IRR for that project. And that's going to be computed using promised contractually specified cash flows. And remember, the IRR is the discount rate, interest rate that makes this true. It makes the NPV equal to 0 when we plug in the right value of the IRR. And IRR is a really good thing to use because it captures all of the project's cash flows, including upfront fees, back-end fees, etc. So it may look, in other words, like a bank is charging you 6% interest on a loan, but if it's also charging you a big upfront fee, effectively it's charging you a higher interest rate than that. And that true higher interest rate is always going to be captured by getting the IRR for the project. So that's why we use the IRR. So let's look at a bond example. So let's say Superco here issues some 3-year bonds with the promised cash flows shown. So they're going to get 100 for each bond, and in return, they're going to give $10 interest, $10 rent on that $100 for 3 years. And at the end of the 3 years, they're going to pay back that principal amount. So, and the company is issuing 10,000 of these, so they get $1 million total. Okay, hooray for them. That's great. So we want to find out what their cost of debt capital is for this bond. So what are we going to do? We're going to take these beautiful cash flows and we're going to find the IRR. Okay, so we've got to use our IRR equation here, okay? And just because I've got early onset Alzheimer's and all that other set of problems that comes with age, I've got to look back here. So I've got my 100, 10, 10, 10, and then 100 in the third year. So I think I can figure this out now. I think I can remember that. Okay. Okay, so plugging in now to our IRR equation, I have 100 minus 10 over 1 plus IRR raised to the 1, 1 plus IRR raised to the 1, and then our second interest payment, 10 divided by 1 plus IRR. I need to discount this payment back by 2 years, so that's going to be raised to the 2. And then finally, our third interest payment and principal gets paid back. So the total there is 110, and I need to discount that back by 3 years. Okay, let's see, does that look good? Looks good, looks good, looks good. I think it's okay. Let's bring it over into Excel and see what we've got. Okay, looks good. And I did a little sneaky thing in here in Excel. I typed in IRR equals, but more importantly, in C10, when I got into C10, I just went up here and typed in IRR and hit return. So now for this spreadsheet, the Excel thinks whatever is in C10 is equal to IRR. So I make it 15%, it thinks it's 15%, and that's kind of nice because then I can do this. Okay, and when I have my IRR equal to 15%, I get something that's not 0. And if I put in 8%, I get something that's not 0, but the sign has changed. So I know it's in between 15% and 8%. So I can say 12%, so it's still in between there somewhere, and I could pretty quickly get to 10%. Okay, so this is clearly not something I'd ask you to do on an exam because I don't want you to spend too much time with trial and error, and you can't use the quadratic equation on this one. But for our purposes here in the lecture, it works really well. So the cost of capital for this company, for this bond issuance, is 10%, okay, which we found by using the IRR technique, and the 10% is the IRR for this project. Okay, another way to think about this, okay, is that the 100 that someone pays for a bond now is equal to 3 tranches of cash, right? One tranche of $9.10 that the $9.10 is going to grow into 10 after a year, and another tranche of $8.26, which is going to grow to $10 after 2 years, and then a final tranche of $82.64, which is going to grow into 110 after 3 years. So this is a very good way to think about it from the bond buyer's perspective. I give you 100 now, it's growing at 10%, and of that 100, $9.10 going to grow by 10%, give me 10 in a year, and et cetera, et cetera. So I think this is a very helpful way to think about this. Okay, so now let's think about weighted average cost of pre-tax debt. Okay, many entities, most entities, I would say, really have more than one debt contract alive at any given time. So we want to be able to compute their total weighted average cost of debt capital when that's true, and when we do have rather access to all of the entity's info, i.e. that means all loans, bonds, and the contracts for these, so we know all the details. So then we can get, if we know all this stuff, we can get their pre-tax total cost of debt, it's just going to be equal to the weighted average for all their debt contracts. So it's going to look like the cost of capital for project 1 times the principal of 1, cost of capital for 2 times the principal of 2, et cetera, et cetera. So for each one of these, we'd have to get the IRR to get the cost of capital, and then we can use this weighted average formula to get the company's pre-tax weighted average cost of capital. So let's do it in an example here where a company has a $2 million, 8% bond maturing in 5 years outstanding, and they have a $5 million loan with 6% IRR maturing in 6 years, and 20 million mortgage with 6.5% IRR amortized in 12 years. So we can, just by taking a weighted average, we can get the total for the company of their pre-tax cost of debt capital. So that's going to be 8% times 2 plus 6% times 5 plus 6.5% times 20, and that's going to be over, okay, the total amount of debt, which is equal to 2 plus 5 plus 20, okay? And I'll leave you to work that out, but if you work it out, I got 6.522%, and you should too. So this is how we get the pre-tax weighted average cost of capital for an entity when it has more than one debt contract outstanding. Okay, so now sometimes, especially if you're going to be an equity analyst working for a mutual fund or hedge fund or something like that, you may not have, and you probably won't have access to all of the debt contracts of the entity, but you will, as usual, have access to the entity's financial statements. So you can still make a good estimate of the cost of debt capital. So here's the way to do it. The weighted average cost of capital for the entity can come from the income statement and the balance sheet, okay? And you want to do this all on yearly basis, okay? So I've got here for a company balance sheet from year 1 and year 2 and income statement from year 1 and year 2. So let's see if we can get their cost of capital. Okay, so for year 2, I want the interest expense in the period. So that would be year 2. So I just go to the income statement and I get that 100, okay? And I need to divide that by the debt at the beginning of the period. So what's the debt at the beginning of year 2? If we're on the balance sheet, it's going to be end of year 1. Remember, balance sheets are always done at the end of the period. So I want the 3,000 here, not the 4,000, okay? Because this represents the interest that they paid on the debt they had at the beginning of the year. So I divide that by 3,000, and that's about 3.33%. Again, I'll leave you to work out the numbers there, but that's pretty much what you should get. Okay, so that's it for our pre-tax measures of cost of debt capital. Let's look now at some post-tax measures. The issue with our pre-tax cost of debt capital is it's not considering how debt may reduce our tax expense, and that's a good thing, right? Right, because that's gonna help us boost our net income. And the way to suss this out, to see how our tax expense might be reduced, is to look on the income statement. So if we want to look holistically at a company, we'll see in just a second that debt interest within reason can really benefit an entity by reducing its tax, which in turn is going to mitigate the impact of interest payments on a company's net income, which is what we all care about, right? All right, so let's see how this works with another straightforward, hopefully, example. We've got here Superco, okay. And what I'm doing here, and I'm going to start doing this a lot for the rest of the semester, I'm going to be looking at an entity under two different conditions, kind of like we did with the Cowboys and Conservatives. I'm going to look at how things would be without any debt and how they would be with debt. Okay, so here I'm looking at what's going on with the debt itself. If there's no debt, clearly nothing, nothing. Tax rate is 50%. That's going to be unaffected by whether the company has debt or not. So in the with debt case, they have $1 million outstanding in debt. Their interest is 10%, so they're paying annually 100,000 interest on that. And now let's go down to the income statement. So revenue, of course, is the same in either case, as things like SGA expense are going to be the same. What's going to be different is the interest expense. So we get down here and we see that the case with debt, the company does have this additional expense of 100, right? Using my K units here. And that's going to mean that its earnings before tax is 100 less than it would be with no debt. So you see we have 750 versus 850. Okay, and then we go ahead and we take the tax rate. So that's 50% of EBT in this case. And I'm saying here that taxable income the taxable income is equal to earnings before tax for this company. I'm just saying that so those of you in the accounting police won't try and ding me for that. Okay, and so we've got our 50% of each of these and we subtract that and we get our net income in each case. And here's the really cool thing, okay? Even though the expenses with the debt went up by 100,000, the hit to net income was only 50,000. And that's because of the tax shield effect, okay? This is what we call the tax shield effect. And the way it works in general, I've made this red because it's an important equation that you should definitely know and hopefully come to love. So the hit on net income for a company, if it takes out a bunch of debt, is going to be 1 minus the tax rate times its interest expense. And you can see clearly that's less than its interest expense because we have 100% minus whatever the tax is here reduces that number and the hit on net income. And remember, we did see this. We didn't really know what we were doing so much or why at the time. But when we were looking at the Cowboys versus the Conservatives, when we were looking at financial leverage, when we were considering ratio analysis, we did actually see this effect. So let me just put in a new column here for us for delta. So here we have 9.0 increase in expense for the levered version of this company, which was the Cowboys, versus the unlevered version of the company. But because of this tax shield effect, the hit to net income is only 6.75. Okay, so that's pretty nice. So let me actually, I just want to put some signs in here. Minus 6.75, and I'll say plus 9, plus 9. Oop. So the expenses went up by 9, but net income only went down by 6.75. Okay, so I got this number. You can get this number just by working out all the math on the income statement, but we could also use our little formula over here, 1 minus the tax rate times the interest expense. So we need to know what's our tax rate here. So it's 25%, okay? So the 6.75 is equal to 1 minus 25% times our interest expense, which is 9, okay? And you should double check me on that, but again, I think you're going to see it works out just fine. And remember, very important about this was that this leverage had a huge effect on ROE, right? So the ROE with no debt is equal to our net income divided by equity, right? And that's equal to 15 over 100 equals 15%. And our ROE with debt is equal to 8.25 over 10, and that's equal to 82.5%. So the tax shield leverage, and particularly the tax shield portion of leverage, helps us a lot to get this juiced up ROE. If we do have a levered company that is profitable. If we're not profitable, it's going to make things much, much worse. Okay, so now let's look at some generalized measures of pre-tax and post-tax cost of debt capital. Okay, so in general, our pre-tax RD is going to be the IRR of the entity's cash flows for debt projects viewed in isolation. Okay, so that's going to be with no income statement consideration. Okay, and our post-tax RD, this is another important equation here, is going to be it's always going to work out to be 1 minus the tax rate times our pre-tax RD, okay? And this is what people call the net cost of debt capital. Okay, so net equals post-tax, because net means after everything that needs to be considered. Okay, and we're going to start valuing entities using methods other than the balance sheet valuation method, and we're going to use our post-tax cost of capital for that. And also another thing to note is if we have something like an LLC or a REIT which doesn't pay income tax, in that case, the post-tax cost of capital is going to equal the pre-tax cost of capital. And then just quickly here, let me also throw in that post-tax is going to be always less than or equal to pre-tax. Maybe a better place to put that would be right up here. And you can see that because clearly of this equation. This is some number less than 1 times the pre-tax number, so it'll reduce it. All right, so now that's pretty much all we need to know about the cost of debt capital. Let's see if we can go on and do the same type of analysis with our cost of equity capital. So in general, our cost of debt capital was pretty easy to estimate. We have some pretty clear methods that we were able to use above, and they were all related in one way or another to contractual terms. So as long as the future is going to look kind of like the past for an entity and it's not going to default, the estimated RDs that we've come up with are really correct. So that's great. The cost of equity capital is a completely different animal. It's usually very difficult to estimate. The reason is we want to understand the growth rate of an investment that has no contractual terms, right? That's the key point here is we're just flying with expectations, not contractual terms. So the cost of equity capital for an entity is almost always going to be a rough estimate. Even for the example that we did in the very beginning of this chapter, that was a very rough estimate because the management of that startup company wasn't promising any of the things like the dividends and the repayment of $1 million at the end of 2 years. That was their expectation if their black box company worked out well. Okay, and in general, the cost of equity capital is going to be directly affected by industry conditions, management issues, macroeconomic issues, etc. Okay, so with that said, there are a bunch of common models for determining the cost of equity capital for an entity. So here's a great survey that was done of cost of equity capital models used by investment banks and hedge funds done in 2010, but still very relevant today. So if we look at the results of this survey, we see that most investment bankers and hedge funds were using and still are using the CAPM method. That's the capital asset pricing model that we looked at briefly in a previous chapter. Another method, which is fairly common, is historical average returns. That would be including dividends, and then you just apply the future. It's going to look like the past and project that forward. There are various modified versions of the CAPM model which aim to improve it, so people use that. And this doesn't add up to 100% because some of the firms clearly are using more than one method. And then folks can use what's called the Gordon growth model, which we'll get to later. And I love this, whatever investors tell us. So that's the kind of firm that you probably don't want to go work for. Okay, but one thing that's very clear here is that CAPM and modified versions of CAPM are used far and away more than anything else. So for that reason, we've got to be familiar with at least the basic CAPM model. So now let's take a deeper dive into the CAPM model. So CAPM stands for the Capital Asset Pricing Model, and here are its key features. It is the best known, most widely used, as we just saw, model for estimating equity cost of capital. Okay, it can also be used for RD. It's not as common, happily, and we're only going to use it for RE. Okay, and other thing that's very important about this model is that it's known to be limited in its accurate application and generally inaccurate. So here are just a couple of good quotes explaining this. So this is from Ivo Welsh, who has an awesome corporate finance book. He's from UCLA, and this is an MBA level book, but it's really great. And he says, among other things about CAPM, despite its wide use, the evidence in favor of CAPM's modeling accuracy is either weak or non-existent. And this is so sad. But I tend to agree with him. I think he's right. And then there is a great academic paper done by this group in the IEEE Journal of Selected Topics in Signal Processing. This is a group of super quants. Okay, they use physics and high-level math to look at all sorts of stuff, applications in finance and physics and bioengineering and everything else. So they turned to finance and looked at CAPM, and in their paper, Empirical Evidence Against CAPM, they said, among other things, there's economically and statistically significant evidence contradicting CAPM in the US stock market over the past 40 years. So that's a fancy way of saying there's a lot of evidence saying it just doesn't work very well. Okay, so in spite of those caveats, okay, we gotta be familiar with it just because it's used so widely. Okay, so assumptions needed for the CAPM model. Again, I don't need you to know what all these are, you just need to know there's a whole bunch of required assumptions. That's all I need you to know about this page. Okay, and with that, with the above assumptions, the CAPM model works like this. It says if we're using a DCF method like NPV to evaluate some equity project called J, then we'd say the NPV of this project J is equal to the sum of the discounted cash flows, just like always, where we're discounting the cash flows with cost of equity capital for project J. So let's see what else I might have missed here. I goes from 0, as always, with the NPV to the number of cash flows. So we're including every stinking cash flow in the project here. And TI is when that cash flow happens. And the cash flow itself is going to be just as usual. No change here. Project risk adjusted cash flows. And these are going to be cash flows to the owners. Not cash flows to owners and lenders, but cash flows to just the shareholders. And NPV, of course, is the net present value for this project, which would be owning shares of this company to the owners. And the RE is the opportunity cost of capital that matches the risk adjustment, the project risk adjustment of the cash flows. So let me just put in project there. Okay. And given all that, then we say that the opportunity cost of capital for this project, which is typically going to be buying shares in this company, okay, for this project J, to owners, not to debt holders, but to shareholders, is equal to our risk-free rate plus the difference between our market rate and our risk-free rate times this thing called beta. And this is the same beta we have looked at in previous chapters. So this equation is called the CAPM equation. Happily, it's pretty simple. And let's make sure I've got everything covered here. So we have RE comma J is the appropriate cost of equity capital for project J. It's what we want to use. Okay, so it's going to be the discount rate that we're going to use with our NPV equation for owners of a company. And RRF is the same RRF that it's always been for us. It's the rate of return for risk-free projects of similar duration, which we're going to measure. We've always been measuring risk-free risk and risk-free rates by treasury bonds. So we'll continue to do that. So I'll just put here same as usual. RM is the expected value rate of return of the market or industry. Okay, so that's like, i.e., average return of SPY, etc. Okay, so this would be where we'd take our 30 years of returns of we'd call the stock market well represented by the SPY ETF. We'd take 30 years of returns, take the average and return, and that would be our RM. And our beta for this project, beta J, is the same as it was in the previous chapter, the correlation and amplitude of project J's returns relative to the market or the industry returns as measured by same linear regression that we looked at in a previous chapter, saying the return of stock J is equal to alpha plus beta, that's the slope, remember, times the return of the market. And again, we would have 30 years worth of data to try and estimate this line, estimate alpha and beta. So you can see this is not going to be an alpha-focused method. Only beta comes into this here. Okay, so let's think carefully about our risk components in our CAPM model. So what risks do we have? We have risk-free risk measured by RRF. We have broad market risk, something like S&P 500 return risk. So that would be the equivalent of, what's our risk return going to be if we buy the spiders to represent the S&P 500? That's represented by RM. And then that correlation of amplitude of the project J, and project J is going to be something like stock of company J. Let's make that a little clearer. Stock returns of company J to the returns of the market or industry, just like it was in the previous chapter. And then, of course, project-specific risk is still measured in the projected cash flows. Okay, so there's one important adjustment we need to think about, just a little bit we need to know about to the basic CAPM formula. It's true because it's found true empirically that the beta, the slope in this regression of returns of stock J to the market, it increases with the financial leverage of company J as measured by, if we measure leverage by debt to enterprise value, which you remember hopefully from ratio analysis, is our debt divided by debt plus market value of equity, okay? And because of that, just looking at the equation, the CAPM equation, as beta gets bigger, all else being equal, the cost of equity capital is going to get bigger, okay? So this clearly means that the cost of equity capital increases with increasing leverage, and that makes sense because we've seen from the example of Trump's properties in Atlantic City, and also our Cowboys versus conservatives, the more leverage you have, the more risk of going bankrupt you have. Okay, so you don't need to know the gory mathematical details, okay? And but I just want to show them to those of you who are interested. This is pretty well modeled actually in a thing called Hamada's equation. And the key thing to note here is that beta is increasing as this debt to enterprise value ratio increases, where we have beta j comma u is the beta of the firm if it had no debt, and that's called the unlevered beta. And TR is the tax rate. So anyway, you don't need to know the gory details of the math. I just wanted to show it to you how it is modeled, and this is actually a pretty reasonable model. Okay, so don't need to know. Don't need to know this equation, but you do need to know. You do need to know this concept. All right, so now let's see if we can understand how to compute our inputs to the CAPM model, and then let's just go ahead and do an example. So RRF is just the rate of return of our risk-free project, similar duration, and we're just going to use forward yields of treasury bonds, and we can look up at Bloomberg. We can just look these up at Bloomberg, Google Finance, or etc. Okay, and the return of the market, that's our expected value return of the stock market. Okay, and the way we'd want to do that is very similar to what we did in the previous chapter. In fact, exactly the same. We'd just say, well, let's represent the market, the stock market, by the S&P 500 index, and let's consider 30 or more years, and we'll just take the average return, and that will be RM. So that's pretty straightforward to compute as well. And another thing to note is that the model is really focused on the difference between the expected market return and the risk-free return, okay? And a lot of folks who use CAPM just try and estimate this directly instead of estimating the market return and then subtracting here. So this is important because this is called the stock market risk premium over the risk-free rate, okay? And because so many people use this instead of computing this individually and subtracting, it's good to know what people think of it and how they use it. So a lot of people have estimated this risk premium of the stock market over the risk-free rate. And the latest set of examples I have for you, I poked around all over the internet in 2008 when GDP was 5.2%. So I found one of the head analysts from Goldman Sachs suggested to use a risk premium of 3%, and a prof at Wharton suggested 4.2%. An analyst at Merrill Lynch suggested 1%. And an analyst at Lehman, yes, there is a Lehman successor firm, suggested 0.5%. And Robert Shiller, who's a Nobel-winning laureate at Yale, suggested 2.4%. And at the time, the Columbia Business School in their MBA program was using 5% in their intro corporate finance course. So just, you can see there's a huge range here, and hopefully you're starting to get out of this that CAPM might not be so good because of all these problems, these huge ranges, which one do you use, et cetera, et cetera. Okay, and then how do we get the beta? The beta we get doing our linear regression exactly the same way we did in the previous chapter. We just get a bunch of 30 years worth of returns for the market represented by the S&P 500 or something, and 30 years of returns for a stock we're thinking about investing in, and we do that linear regression, and out of that pops alpha and beta. So the nice thing is that clearly we can compute all of these things. This is maybe the squishiest, as we saw, but at least we can compute all of these quantities one way or another, or we can just directly steal someone else's estimate for them. Nothing wrong with that. All right, so with that in mind, let's do an example. Let's evaluate a potential purchase of Walmart stock using the CAPM model. Okay, so let's go back in time a little bit, but not much. Let's say we're a hedge fund manager in 2018, and our investment mission for our hedge fund is we make one-year purchases of low volatility stocks that have, in our humble opinion, IOHO stands for in our humble opinion, a high probability of being positive NPV investments. Okay, so that's a fine mission statement. Nothing wrong with that, and let's go from there. So, given that mission statement, the hedge fund is considering buying shares of stock of Walmart here. Okay, and they've got a graph of the price of the SPY ETF that follows the S&P 500 in dark blue, and a graph of the price of Walmart in light blue. And just looking at this without having to do 30 years worth of returns and getting standard deviations or values at risk or anything like that, you can clearly see that Walmart is much less volatile than the S&P 500. And if you were at all concerned about that, you could go ahead and compare standard deviations of returns or value at risk or something like that, and that would confirm this. Okay, so clearly Walmart does fit our investing mission, right? It's a big stock. It's probably, I'm sure, actually it is in the S&P 500, so it's just fitting our investment mission very nicely. So now, given that, the our managing director wants us to find, first of all, what's the cost of capital we should use in analyzing our potential purchase of Walmart. Use the CAPM model, okay? And then secondly, let's find out, once we've got that in our pocket, what if we buy $1 million worth of shares today and we estimate we're going to get 25,000 in dividends in 6 months and again in a year, and we estimate that Walmart's stock price will appreciate by 10% over a year, and then we sell the stock, that fits our mission. Is this a positive NPV project for the hedge fund? So let's see if we can figure all of this out. So let's do A first. Okay, we want to determine our equity cost of capital using the CAPM model. So really, we just need to get all our inputs here and then multiply them and add them together, and we're done. Okay, so as usual, RF is our risk-free rate. So all we do is we go out to Bloomberg, okay? We go out to Bloomberg and we find the average promised interest rate of Treasury bonds with a year to maturity. We can take promise because we feel the probability of Treasury bonds not being paid off is so low, it's negligible. So we just go out to Bloomberg.com, we look that up, and we find 3%. Okay. And we have, of course, some key assumptions here that, of course, the future is going to look like the past, et cetera, et cetera. And now I'm going to go with, instead of taking 30 years to get the average RM, I'm gonna just use the stock market risk premium, which is RM minus RF. Okay, so the nice thing about that, because as you know, I'm very lazy, is instead of doing 30 years worth of returns and getting the average and maybe making a mistake and all that stuff, I can just steal what some very smart people have to say about this. So just because it's my alma mater and whatever, I'm going to choose out of all these possibilities, I'm going to say that the Columbia Business School's estimate is best. That's probably, just speaking off the record here, parenthetically, that's probably pretty stupid because it's the highest of all of these. So a smarter thing to do might be to take the average of all of these, but whatever, okay? I have chosen, I'm doing this lecture. When you do the lecture, you can do something better, but I have chosen the Columbia Business School's 5%. So I'm saying that the market risk premium over the risk-free rate is 5%. So now I've got pretty much everything I need. All I need is beta. So let's go see if we can get beta for this. So remember, beta is going to come from our linear regression, or also if we wanted to instead compute correlation coefficients between Walmart and the S&P 500 and get standard deviations, we could use that. But probably the best, most direct way to get beta is to just do a linear regression of the returns of Walmart versus the market for the past 30 years. And so we're going to say for the market, we'll choose to represent the market, the SPY ETF, as we have been doing. The reason why is it tracks the returns of the S&P 500 very closely. Walmart is a large cap stock. These are large cap stocks, so this is a good representation of the market. And I'm choosing SPY instead of the index itself because we can actually invest in SPY, right? So if Walmart doesn't look good and we're sitting on $1 million of clients' money, maybe we throw that into the SPY instead. Okay, so our key assumptions for assuming computing our beta with our historical returns are, again, if we're using historical returns to compute this number, we are assuming the future will look like the past, so the future beta is going to look like the historical beta. And also, we're getting this from linear regression, and it better have a high R-squared value. Okay, and the R-squared equals X% says X% of WMT returns are explained by SPY returns. Okay, so that's going to be important for us. Okay, so I went through and I did the regression for us, and I don't remember exactly why, but I just used 24 years instead of 30 years. I'm sure I had a good reason for that at the time, but I honestly can't recall it. 30 years would have been better. So here's a list of the returns that I had for Walmart and SPY. So first year, second year, Walmart 4.44%, SPY 22.15, et cetera, et cetera, et cetera. So I got the average was 6% for Walmart, almost 14% for SPY. Walmart clearly, here we go, here's our much lower standard deviation, so it's definitely not nearly as volatile as SPY. And I got our correlation coefficient of 73%. And then from the linear regression, which I plotted for us over here, I got the beta. So the slope is very low, right? Here, if it were 0.5, that would be a 45-degree slope. So very low slope. And the R-squared, which also pops out of the regression when you do that in Excel, was 53%. So here's what the data looks like when we plot it. Each blue dot here represents on the y-axis what the return of Walmart was given what the return for the SPY was on the x-axis. So you can see there's a lot of spread here, but there's also, it looks like you could reasonably maybe draw a line through this, and that's what the linear regression went ahead and did, and it gave us this line, which is represented by the sort of pumpkin orange dots there. So when the S&P is returning nothing, Walmart is expected on average to be returning 2.2%, and that's our alpha down here. And the beta is the slope, clearly much less than 45 degrees here. And the R-squared of 53%. Okay, so let's put in warning. Okay, R-squared says that only about 50% of WMT return behavior is predicted by the behavior of the SPY returns. So that's maybe not so good. It would be nice to have something higher than that. But now we have all the inputs that we need, so that's great. Okay, so we have our RRF was 3.0%, plus we had, I took that 5.0%, which is probably dodgy, but nonetheless, that's what I chose. And our beta, I don't remember, it was 0.2 something, 0.273. Okay, so times 0.273. Okay, and if you work that out, you should confirm this, that you get 4.37%. Okay, so what is that? That's the estimated equity cost of capital for Walmart, and it's what we want to use for discounting. So it's what we want to use for discounting with our NPV method for Walmart stock. And remember, I gave you that warning on the prior page here that the R squared is 53%. That's kind of low. Okay, and as always here, everything we've done going into this model is assuming the future looks like the past, which is very often, as we know, a bogus assumption. Okay, so that's part A. So we were able to estimate the equity cost of capital. And now for part B. So we didn't want to do that all for nothing, right? We're working in this hedge fund. We were thinking about buying stocks for our customers, right? So we want to know, based on additional assumptions here about Walmart, if this looks like a positive NPV project for us. So what would be the project? So we buy $1 million worth of shares. Our best estimate, and this is just our boss's estimate that was given to us, is that we'd get 25,000 of dividends in 6 months. And again, in a year. And also, our boss estimates that Walmart stock price will appreciate by about 10% in a year. And we're going to sell at the end of a year, so we'd get our 1.1 times 1,000 back there. And we want to know, is this a positive NPV project? So as always with things like this, it's good to draw a cash flow diagram. So here's when we buy all the shares, we get the dividend, and we sell the shares. And this all happens over the course of 1 year. So how are we going to do this here? We just use our NPV formula. And here, our opportunity cost of capital, the CAPM model says to us, when you use the CAPM model, what do you use for opportunity cost of capital? You use RE. So that's what we need to do here. Okay, so our NPV is, let me just go back because again of the early onset Alzheimer's problem that I have here. I think I got all my cash flows now lined up, 1,000, 25, 25, and 1.1 times 1,000. So our NPV is going to be minus 1,000 and then plus 25 over 1 plus 4.37%. And what's that raised to? That's in 6 months, and I'm measuring things in years. So that's going to be 0.5. And then plus, and so this is going to be 25. We get that second dividend plus 1.1 times 1,000. That gives us our appreciation, our expected appreciation of the amount of money we put in to buy shares there of 10%. And this gets discounted by a year, 1 plus 4.37%. And this needs to be raised to the 1. And let's just take this guy into Excel. And whoops, not quite yet because I see I have a mistake here. All right. And I still have a mistake here. 1 plus 4.37%. Okay. And let's bring this into Excel and see what we got here. Okay, and we got 102.367. And that is greater than 0 in most circles, so that's good. So based on all of our views and assumptions, and you see how many we've had to make to do this, we should buy the shares of WMT. Okay, so for us, we think that this would be a good project, and we get back to our general manager with that, and that's it. Okay, and the rest of this chapter is an appendix about refining the CAPM model. Remember, we did look at some folks use refined versions, modified versions of the CAPM model. If you're super interested in that, you can read all about it in this appendix. And for everyone else, thank you again as always, and I'll look forward to catching up with you again soon.